All right, welcome everybody to Finance Essentials with Danny Hudson. I am your host, Danny Hudson, and I must say I am so excited for today's show. I cannot wait. One of the things that you guys may know about me is that I typically tend to get excited whenever it comes to learning something new. And boy, over the last few days, I have been learning all kinds of new stuff. I had several requests. Actually, I had quite a few requests, probably more than several, but of people that wanted to have a little bit more understanding and idea of what is going on with, GameStop, Wall Street bets, Reddit, short squeeze, that type of thing. And because I love it, I think this is so fascinating that I wanted to do an episode. And I had a few drinks in me last night, and I'm like, you know what? Tomorrow is the day. And so here I am today. I compiled some notes, and that way I can go ahead and dive right into it and let you guys in on kind of what's going on and help break it down to a fundamental level that's easy to understand. But then also to give you guys kind of an idea of how all of this is currently playing out. I do want to premise that with a few comments. The first one is that Entrepreneur Week will continue next week. So obviously when something like this comes up, it happens where some stuff gets pushed back a little bit, but that's all right. That's okay. We'll make it work, and we'll finish strong just like we always do. The second one is I'm probably going to get some of these details wrong. I'm not an expert when it comes to some of this type of deal, but I do believe that I have the overall gist, and I'm definitely capable of being able to help you guys understand and really know who the players are, what the circumstances are looking like, and then how this potentially could play out. Hopefully, hopefully. And then third, I am not providing any type of financial advice. If anything, you'd probably be better off doing the opposite of what I am suggesting or whatever I might bring up. But obviously, I'm not going to provide you guys any kind of recommendations or strategies when it comes to investing. And again, like I said, that's probably better for you and your family if you don't listen to me anyway. So to give you guys a little bit of a backstory here. Earlier this year, there was a handful of stocks that were really starting to be shorted by specific hedge funds, right? So GameStop is the big one, but then there was also BlackBerry, Nokia, AMC Theaters, Bed Bath and Beyond, American Airlines, so on and so forth. And so there was another small handful. And what that means is that, these companies, these hedge funds were basically betting on, these firms to go down, and then that way they could make some money. But so that's kind of like the 30,000 foot view as far as what's going on. But what I wanted to do is break it down to, what type of investors, what are investors when people talk about, market makers, or industrial or an institutional investor, what does that mean? And then also to kind of explain what a short is, and how people can short stock, and short these companies, and then give you a little bit of context on who the players are, what the timeline was, how much money has been lost or gained, and then kind of explain how it's playing out right now in the media, social media, and what happens to come next. So first, what I want to do is I want to give you a little bit of backstory as far as the three main players when it comes to kind of investing in stocks, right? So when you go, you log on to TD Ameritrade or you use Robinhood, what are some of these terms that people would use? So market maker is the first one, and so a market maker is basically defined as a firm or individual who quotes two-sided markets, who provides bids and asks. So an example would be, say you have a stock and it's quoted at $10 to $10.05, 100 by 500. What that means is that they'll offer to buy 100 shares for $10, and then they'll offer to sell 500 shares at $10.05. And then the other people who are participating, they will get to buy and sell essentially at those price levels, right? So their reward of being a market maker is essentially that premium that's between the spread between the bid and the ask. And so the easiest way to kind of explain this is that, say for example, you go on to TD Ameritrade and you purchase 100 shares of Microsoft, right? You're probably purchasing that from like a brokerage house or a market maker, someone who has bought those shares from someone else and they're holding it and then they sell it to you. You're not necessarily directly connected to a seller. So when you buy it, it's not as though I'm selling 100 shares and then you buy it directly. I buy it into a brokerage firm or a market maker. They hold it and then you purchase it from them. And so again, that premium between the bid and the ask is kind of how they get paid, right? There's a little bit of risk in there as far as volatility goes, and so that's kind of, that's kind of their reward. And then you have your institutional investors. So these are your persons or organizations that trade securities in quantities large enough that qualifies for preferential treatment and lower fees. So think about your pension funds, mutual funds, hedge funds, 401k managers, things along those lines that have massive portfolios, and then they tend to have specific advantages that you and I wouldn't necessarily have. One of the easiest things that you can do is that if you are looking at like pre-market or aftermarket trades and you can't buy anything or sell anything during that time period, but you'll still see the stock going up and down and fluctuating and that kind of thing. And that's because there are people who have these large portfolios that have advantages where they have access to pre and aftermarket trading that people like you and I would not necessarily have. And then the third one is the retail investor, which is basically like you and I, right? So people who are, they would consider as amateurs. Well, I mean, I'm definitely an amateur. I'm not very good at it at all. But people like you and I who, we trade and we spend, a few $100 here, or $1,000 there, or $50 here, whatever it might be, we would be considered a retail investor. And so we're generally going to use a broker, again, like TD Ameritrade or JP Morgan Chase or, Morgan Stanley or whoever you might use to kind of execute your trades. And so those are the three big those are the three big players in terms of categories and terminology that typically tends to participate in the market. And so when I'm talking about shorting, and so then what I want to do is I want to try to be able to explain shorting stock. So essentially you have three ways to be able to short a stock. I'm not going into calls and I mean, I won't really even use puts either. I mean, a little bit in terms of context for some of the conversation, but I basically want to explain shorting positions because that is what is relevant for the current discussion. And so when you short a stock, you have essentially three ways of being able to do it, right? So you can buy a put option with a predetermined date with the right to sell a stock at a certain price. So if it goes down and the contract executes, you make the difference, or you could sell the contract in the meantime. So the easiest way to explain that is that if you buy the contract at $10, and then it goes down to $9, and then at the time it executes, and then you make that additional dollar as your profit, right? And the second way of being able to do it is that if you borrow from an institutional investor, right? So again, think of like a pension fund, right? So a pension fund may be holding 10 million shares of Microsoft. And then what the hedge fund or whoever might do is they will borrow those shares, and then what they will do is they will pay an interest, right? Interest on that to the institutional investor that they borrowed those funds, and then they will short that, right? And so what you'll have happen is a lot of times is you'll have hedge fund managers and the like, and they'll go on CNBC. And like, so Cintron Research is probably one of the more notable ones. They're a pretty big short, seller house. and they will dog a stock, right? They will say Tesla, they're never going to meet their sales goals. They're not going to be able to do this. Their fundamentals are off. Their profit to earnings, whatever, all of their fundamentals are wrong. And then what they'll do is they'll drive that stock down, and then they'll execute those contracts, and then they will reap the rewards from that. And so they don't actually own the stock, and what they're doing is they're basically borrowing those shares to be able to short, and then they give the interest and the shares back to the institutional investor who had that, and then they get to keep the profit. And then the third option, which is the real fun one, is naked short selling, right? So naked short selling sounds exactly like, well, I guess it is exactly what it sounds like. You've got no shares, right? So you are kind of making it up as you go along. The advantage of it is that you don't have to pay interest on the shares that you borrowed, right? But you can still go out there and you can basically put these contracts, these short contracts out there on shares that you don't really own and they don't really exist. But as long as they go down, then you get to collect a premium, right? So you can tank the stock, buy the imaginary stock back later, and then voila, you've made a profit without paying the interest on there. And so what you'll find is that there are actually quite a few companies that tend to balance between that number 2 and number 3, right? So there are some borrowed shares, and then sometimes there are not borrowed shares. And that is what leads us into the current situation with Gamestop. So Gamestop is the big one who is really making the news right now. And it's for several reasons. So essentially what happened was this was back in, earlier this month in January of 2021. And the stock was trading at about $19 or so. And it started to kind of go up from there. And then what happened was Citron and other places, they started to try to short it, right? So their goal, and this is the really nasty part when it comes to this, is that essentially what their goal is dog this stock as much as they can, drive the price to essentially bankruptcy, and then turn around and then buy that stock at that price. So if they're at if it's trading at $30 and they're able to go out there and just slam it all the way down to $1, they have basically now reaped that reward of everything that is in between. And I think too, so it was starting around 19 at the beginning of this, and then currently right now I don't have my phone with me, but last I saw it was in about the mid 2s, so like 220, 230, maybe 250, and I've seen it even as high as in the 400s, per share. And so what they'll do is they'll come out and they'll try to basically suppress the stock, and then that way they get to reap the rewards. Well, the problem ended up happening with GameStop, and this is the beautiful part about this, is that they actually borrowed, the institutional investors, the hedge funds, actually borrowed about 140% of the outstanding shares to short, right? So GameStop was up there at, $20 to $40, and all of these guys are like, this is free money. We're gonna borrow some shares, we're gonna make up some shares, and then we are just going to run this stock into the ground, right? And then we're just gonna be able to make all of this money in this pandemic, this brick and mortar place. Who cares, right? We're just gonna to run them into the ground and make the money. And so what ended up happening was like I mentioned, they had put in about 140% of the shares. So essentially, what they did was they are shorting more shares than actually exist. So if you've got 100 shares that are outstanding, and they would have actually shorted 140 shares, right? So essentially you've got 40% that is basically made up. So they're borrowing the same shares, over and over and over again, continuing to short it, increase their position, their leverage, and attempt to drive it down to zero. Now, the beauty of this, though, is that as people caught on to this, most notably Wall Street Bets, which is a subreddit of Reddit, they caught wind of this. And so what you had was you had several people, that started off and basically saying, hey, look, you know what? This is over shorted, right? The shorts exist more than actual shares. We'll just start buying up shares. And so they started buying up shares. And what that means is that as shares are being bought, right, the price is going up because you're seeing, oh, well, the price is at 25 bucks. That's a pretty good deal because if I buy it at 25 bucks, we keep getting the price to rise. And these guys have these contracts that will basically work out at a specific price. The value of these contracts are going to continue to go down because the stock price is going up. And then whenever those contracts get executed, they're responsible for the amount of shares that they have to disperse. So again, think about it where if the stock is at $10, they execute it and their contract is for $2, but yet instead that the price of that contract actually goes up to $20. Now, instead of being able to sell and buy at $2, they're actually having to buy shares at $20 to be able to legally fill that contract. And so as you can tell, other people started catching on to this, and then it blew up to basically what it is now. And so all of these people, people like you and I, these retail investors, are catching wind on how Wall Street and these hedge funds have essentially manipulated the game, right? To where they can basically buy a bunch of shorts, tank the company, sell those contracts, make the profits, and then who cares about the company? So whereas other people realize, they're like, oh, wait a second, if we just buy up all the shares, then they're going to have to purchase all of these shares to be able to execute these contracts. And so that's why it's been going on a buying frenzy. I believe at one point in time yesterday, and so again, this data is probably outdated. I believe yesterday that there are approximately 15 million shares of call contracts that are expiring tomorrow, right? And these are in the money contracts, right? So in the money basically means that if you have a contract that says that you're able to buy shares at $40 and the current share price is at $100, that contract says that you are able to purchase those shares at $40 rather than, the market price, which is $100. And so there was approximately 15 million or so in the money shares that are going to be executed tomorrow, which is the 29th of January. Now, again, the numbers are probably a little bit outdated as there's been a bit of a selling frenzy going on today, which we'll get into, in a few minutes. But as of yesterday, there were only about 1 million or so outstanding shares because people have been buying them all up. And so what ends up happening is that as these contracts are getting executed, they're having to buy shares to be able to fill them. And so you can imagine, now not all those 15 million are going to be filled, right? There are people like me who don't necessarily have the money to be able to fill those contracts. But say even there's like 6 million, right? 6 million or 7 million of these shares are going to be executed in these contracts, and only 1 million shares are going to be able to even be purchased because that's the only number that's outstanding. And so what that means is that's going to drive the price up even further, which is where you get your short squeeze. Because then what you have happen is you have other contracts, short contracts, that are essentially replacing the old short contracts. So say the old ones were at $40, they buy some new ones at $100, and now as the price keeps going up above 100, now those contracts will also have to be executed at that price. So now they are doubling and tripling their losses as they're going, and as they are having to buy these shares to fulfill these contracts, they are having to try to recoup these losses of their old contracts. And you can kind of see how it's squeezing the price, and the price keeps going up because people are acknowledging and understanding the fact that they can't cover their shorts because they have taken out 140% of the outstanding shares for these contracts. So theoretically, it could be a limitless price, right? If people refuse to sell, I mean, I'm sure probably there would be some legalities and stuff, and I'm sure someone who's listening is a bit more familiar, and they would understand kind of where that would go. But basically what's going to happen is that other people are going to pile on and start purchasing those shares as well, because they know that as these contracts get executed, that they're going to have to buy these shares, and so the value of them keeps going up. So that kind of gives you an idea of what the short squeeze is. And I use GameStop as the example because they're the only ones that are actually above 100% shorted, right? A lot of the other ones are closer to like 60%. You know, I think I saw a couple that were at like 70-ish%, but GameStop is the only one that's above 100%, which, you know, makes this a you know, a very beautiful and weird and awkward kind of situation. So to give you guys a bit of an idea in terms of the hedge funds losses when it comes to this, is that as of January 25th, hedge funds had lost about $6 billion while maintaining their 140% short position, right? So they're continuing to have these losses while they are continually shorting the stock. And so Melvin Capital, so Citron at the beginning was talking about it, and then I believe he got out of his position, but then Melvin Capital has lost billions of dollars, right? Because Melvin Capital is the main shorter of this. And then what ended up happening is that Citadel and Point72, who are two other hedge funds, have basically floated them $3 billion to keep purchasing to keep purchasing shorts to help keep, you know, the liquidity there, because basically what would happen is that he would just go belly up, right? Because he wouldn't have Melvin Capital wouldn't have the money to be able to take care of it. So he threw out some lifelines, and he was like, come on, bros, hop on. I need some money here. We got to keep this short position going, or we're all basically going belly up. And you know, if you've got short positions, we're going to have to sell other positions that they have to be able to provide liquidity, to be able to fulfill these contracts, and so on. And so basically these guys came in, they floated several more billions to kind of help keep this short going. And then as people are catching on to this, and they're saying, you know what, screw you, Mr. Wall Street hedge fund guy, you know, you guys have taken enough money out of our pocket over the last decades by doing your shorts and by coming out and taking advantage of the market and doing all of this, and you guys are reaping billions of dollars of rewards. So we don't think so. We're going to come out and we're going to keep buying up these shares. So a GameStop share that was at one point in time like $4 or $5 is now going for, like I said, like $240, and it's reached over $400. And GameStop, I mean, they haven't changed in 2 weeks, right? Their business model hasn't really changed, but because of this short squeeze, people are continuing to pile on to really try to stick it to these hedge funds. And so one of the other things that I wanted to discuss too is people are thinking, well, you know, this seems like it's a bit of a house of cards, right? So who's going to be the one that's left holding the bag at the end of this? And so one of the things that I did a little bit of reading about, and again, people probably correct me if this is wrong, but there's a thing called a short ratio, or a days to cover. And so what this is it's the expected number of days to close out a company's shorted position. And how it's calculated is the number of shorted shares divided by the average daily trading value or volume. So basically what they do is they take the number of shares that are shorted, and then what they'll do is they take the number of the average daily volume, and then they will say if all of these shares are executed and sold, this is how many days it will take them to be able to fulfill these contracts. And so right now, it's about 6 days, right? So based off of average daily trading value, the number of shares that are shorted, it would take them approximately 6 days to be able to fulfill all of those contracts. Now that's just based off of the current formula, right? That's not saying that if people just hold and very few people actually sell, that they will be able to fulfill that in 6 days. And they haven't had to start covering these short positions yet. The thought is that this will start, potentially anyway, tomorrow, which would be January 29th. And so when people are thinking, well, what's the timing look like and that kind of thing, based off of average volumes and based off of the current shorts, this should at least go one whole trading week where they are attempting to try to acquire shares to be able to fulfill these contracts. Now, this is where the last couple of days come in, and this is where things start to get really hairy, and it really allows people to understand how Wall Street works, how these brokerage firms work, even to a point how the media works. Places like CNBC, Market Watch, Reuters. CNBC has generally been kind of the mouthpiece of Wall Street. You can tune into CNBC, and what you'll see is you'll see hedge fund managers, and they're in there. And this actually happened, about a year ago when the economy was really tanking, is that you saw hedge fund managers that would come onto CNBC and they would say, hotel companies are never going to be able to recover. Lodging is never going to be the same, so on and so forth. And then what you find out is several days later, they take huge positions long positions in places like Marriott or Hilton or Choice, right? Because what they did was they came on CNBC, trashed the industry, and the industry tanks another 10%. And then they buy it all up, and then they hold that long term, and then that's how they'll make money. And so CNBC is pretty notorious when it comes to this. But then, like I said too, there are also other news outlets that have basically been covering for these guys, for these hedge fund guys and these mouthpieces, and they say, oh well, these guys, Melvin closed out their short positions, right? They took care of everything they needed to do. They closed out. They're done, and it's wrong. You can see the percentage of shares that are still shorted, and they're not changed. And so what you're finding is you're finding places like CNBC and other Market Watch and some other news outlets that are basically saying, look, guys, they sold out. It's okay. You can sell your shares and you can take your profit and whatever. And it's just blatantly untrue. It's just not true. But today, it's actually gotten a little bit more fun, because now what we're finding is that these losses are now in the tens of billions. I saw a Reuters article earlier today that said that current year-to-date losses for heavily shorted stocks, their losses are like $60 billion or $70 billion. So now what they're doing is they are putting pressure on the brokerage firms, Robinhood being the biggest one, to stop allowing these companies to be traded. So if you are on Robinhood, you cannot buy or sell GameStop. You cannot buy AMC. You cannot buy BlackBerry. You can sell them, right? And so what you're seeing blatant manipulation that's going on that is basically driving the price down because people can't act as they normally would. And so now you're seeing politicians and stuff that are kind of chiming in, and you're starting to see there's already been a class action lawsuit that has popped up against Robinhood. But to give you a little bit of an idea of why Robinhood is one of the main players of this, is that Citadel, who is one of the main players and backers in this short position with Melvin Capital, what they do is they buy your trading data from Robinhood, and then they front load all of those trades that people are initiating. So about 40% of the revenue that goes to Robinhood actually comes from Citadel by buying your trading data and my trading data until I get rid of Robinhood. And then they sell you those trades at a profit that you are going to execute. So Robinhood is basically the low man on the totem pole here, whereas Melvin and Citadel and point 42 or point 72, those guys are the ones that are basically pressuring. Well, this is speculation, that these guys are the ones that are pressuring these brokerages to basically say, I don't care what you have to do. No one can buy or sell it. It even got to the point earlier today where if you search for GameStop on Robinhood, it wouldn't even show up. So you couldn't even find some of these stock tickers on Robinhood because they just hit them. So you try to do a search for BlackBerry and it just doesn't pop up. And so it's blatant manipulation that's going on, that's being pressured by these hedge funds who are essentially losing everything. Well, not everything, but they are losing billions and tens of billions of dollars because they got greedy and they thought that they could hammer GameStop into the ground and turn around and make billions off of it. And the people just said, no, we're not going to take it anymore. And so where we are right now at this point in time is that several people in government, so AOC, I know Ted Cruz, I believe Rashida Tlaib has said something, and then there's been a handful of other people on the government side that is looking at investigations into these brokerages like Robinhood, and looking at doing investigations to see if legal action needs to be taken there. One of the other things that's very interesting is that there has been delete Robinhood trends on Twitter. Also, too, the Play Store, their rating for their app is down to about 1 star because of this. So everybody's been deleting them and then also leaving them a very bad review. But they're also looking at filing for an IPO in the not too distant future. So Robinhood's thought process here, and again, this is speculation, Robinhood's thought process here is we can't piss off our revenue streams like Citadel, right? They constitute almost half of our revenue. If we make them angry, they might not buy our data. How are we going to go public and be able to sell, our shares if we don't have any revenue? And so they're basically the lapdogs of these hedge funds who are the ones that are paying them for all of their data. And it's not just them. I've heard some other ones have also been very problematic, but Robinhood obviously is the big one because that's the one that a lot of retail investors use. And so where we go next is very hard to say. Like I mentioned, there's been at least one class action lawsuit that's been filed. I know I've already filed a complaint with the SEC. I believe there's probably also been a lot of other people that have done so as well. But we don't know exactly how this is going to play out. All I know is that as long as people continue to buy and they continue to hold, is that we're going to continue to see large losses on Wall Street, which at this point no one seems to mind except CNBC minds, but most people don't seem to mind, and so right now it's just a crazy S show, right? Because people just don't know exactly how this is going to play out, and other stocks obviously too have been bought up a lot, to constitute those tens of billions of losses. But GameStop is the big one. So I hope that sheds a little bit of light on what's going on right now regarding GameStop and the short squeeze. Basically, the cliff notes of it is that these hedge funds got way overconfident. They thought that they were invincible, that they could just continue to make billions and billions of dollars on the backs of just regular normal people, and they got caught. Right? They got caught off guard, and now they're angry that they're the ones that are taking billions of dollars of losses rather than you or me, right? Not that I have a billion to lose, but collectively we have billions that we could lose. And so now they're mad, right? They're mad. They are doing everything they can. And chances are they're probably going to be dealing with these class action lawsuits, and they're probably going to be dealing with white criminal convictions. But I think at this point in time, they intend to deal with those rather than continue to deal with these tens of billions of dollars of losses because of these stocks that they have continued to short. So I hope that gives you a good idea as far as of what the players here are, right? I mean, it's basically normal people versus Wall Street, and Wall Street throws up the not fair flag. And where it ends, I don't know, but I know it's been awesome to watch. And for me, I'm pulling for the little guy here. I hope no one's actually playing with money that they can't afford to lose. I own a little bit of GameStop. I own a little bit of BlackBerry. I own a little bit of AMC. And a lot of it is mainly sticking to the man. I mean, none of it is money. I mean, I don't want to lose any of it, but if it comes down to it, if I lose, a few $100 and they lose tens of billions, well, it's not the end of the world. But yeah, so I love this show. I love this episode. I really hope that helps you guys out a lot as far as being able to understand it. It's definitely an evolving scenario and situation, and so just keep an eye on it, man, because it is fascinating. Stuff like this does not happen every day. But I hope you enjoy the rest of your day and stay in touch and keep in contact as far as following along with this goes. And if I got any of this wrong, let me know. Like I said, I'm not an expert, and so if I got some of that wrong, please feel free to correct me. But other than that, we'll talk to you next time. All right, bye.